Assalamualaikum and a very good day, Madam Chairperson and members of the board. Thank you for giving our financial team the opportunity to present today's investment analysis. Our objective is to evaluate the financial performance of two leading companies in Malaysia's consumer product sector, namely Nestle Malaysia Berhad and Dutch Lady Milk Industries Berhad. I am AMNA HAKIM, and these are my fellow research team. The first company under consideration is Nestle Malaysia Berhad, one of Malaysia's largest food and beverage manufacturers with more than a century of operations. The company owns well-known brands such as Milo, Maggi, Nescafe, and KitKat, and has established a strong market presence through continuous product innovation and extensive distribution. The second company is Dutch Lady Milk Industries Berhad, a leading dairy producer in Malaysia and a subsidiary of Royal Friesland Campina. The company specializes in dairy-based products, including milk, infant formula, and yogurt, and recently enhanced its production capabilities through its new Industry 4.0 smart manufacturing facility. These two companies were selected because they provide a fair basis for comparison. Both operate within the consumer products and service sector, are listed on Bursa Malaysia, and are classified as Sharia-compliant companies. They also share the same financial year-end, allowing consistent financial comparison. As direct competitors in Malaysia's fast-moving consumer goods industry, they present suitable investment options for evaluation. Having established the background of both companies, the presentation will now proceed with an analysis of their financial ratios, beginning with the liquidity analysis. I now invite my colleague to continue the presentation.
I am YASMIN HANANI. Now, let's start to the financial ratio analysis. Firstly is liquidity ratio, demonstrate if the companies have enough short-term asset to pay off what they owe. Based on table 1.0, Dutch Lady has a stronger position. Their current ratio is 0.89 times, compared to Nestle 0.52 times. This means Dutch Lady has more short-term resources available to cover their immediate liabilities. Moving on to the quick ratio, which remove inventory because it takes time to sell. Dutch Lady still leads at 0.43 times compared to Nestle 0.19 times. This ratio is much stricter test of safety. It tells us how well a company can pay its bills if their sales suddenly drop and they can't rely on selling their warehouse stock. Lastly, looking at the cash ratio, which is actual cash in the bank, Dutch Lady stands at 0.19 times, while Nestle is at a very low 0.002 times. The cash ratio is the ultimate worst-case scenario test. It completely ignores inventory and unpaid bills from customers, measuring only hard cash and bank balances. Dutch Lady ratio means they keep actual cash buffer ready for immediate use, while Nestle ratio means they carry almost zero idle cash. They do not leave money sitting around doing nothing. Simple terms, the liquidity ratio show that Dutch Lady choose a safer path. They keep a cash cushion to handle unexpected bills, while Nestle operate on a very tight budget with almost no spare cash, making them more reliant on their daily incoming money. Now, let's look at efficiency ratio, which is essentially how hard a company makes its money work. Nestle is a masterclass in operational speed. Their inventory turnover is 5.31 times a year, within Dutch Lady 4.89 times. This means Nestle products spend less time sitting in warehouse and move out to consumer much faster. Furthermore, their average collection period is slightly shorter at 26.1 days, meaning they get paid by their customer faster. For the fixed asset turnover, it shows how effectively this company use their long-term physical asset like factories, machinery, and equipment to generate sales. Nestle holds a major advantage here with a ratio of 3.94 times. This means that for every ringgit they have invested in their manufacturing plants and machinery, they generate nearly 4 times that amount in sales. Dutch Lady is noticeably lower at 2.38 times. This tells us that Nestle factories are running at a much higher production efficiency, making better use of their infrastructure to drive top-line revenue. Next is the total asset turnover. that gives us the big picture of overall management efficiency. It measures how well a company utilizes everything it owns, including both its short-term asset and long-term asset to create revenue. Nestle leads this metric at 1.89 times compared to Dutch Lady 1.38 times. This indicates that across the entire business, Nestle operates at a much faster pace. They turn their entire asset base over almost twice a year to generate sales. Because Nestle keeps very little idle cash and moves its inventory rapidly, their overall asset base is highly active, whereas Dutch Lady assets are turning over at a much slower corporate rhythm. That's all from me. I will now hand the floor over to my next team member to continue with the next part of our analysis.
Thank you, distinguished members of the board. I am Ms. DALILA. I will now present the solvency and profitability analysis of the two companies under consideration for investment. Let's take a look at this solvency analysis. These ratios evaluate each company's ability to meet its long-term financial obligations and assess its financial risks. Nestle recorded a debt-to-equity ratio of 5.32 compared to 0.90 for Dutch Lady, indicating that it relies much more heavily on debt financing and therefore has higher financial leverage. This is further supported by its debt-to-assets ratio of 0.8, meaning that approximately 80% of its assets are financed by liabilities, whereas Dutch Lady recorded 0.47, reflecting lower debt dependence and a more conservative capital structure. Looking at the interest coverage ratio, both companies are financially capable of meeting their interest obligations, while Nestle recording 30.56 times and Dutch Lady 19.36 times. Although both ratios are healthy, Dutch Lady's higher ratio provides a greater margin of safety, indicating stronger debt servicing capability and lower financial risk overall. Next, moving on to the profitability analysis. These ratios measures how effectively a company generates profit from its sales and manages its operating costs. Nestle recorded a gross profit margin of 30.35%, slightly higher than Dutch Lady's 29.04%, indicating slightly better control over production costs and stronger pricing power. It also achieved a higher operating profit margin of 11.06% compared to 10.31%, suggesting greater efficiency in managing operating expenses. Lastly, Nestle recorded a net profit margin of 7.46% compared to 6.88% for Dutch Lady, meaning it converts a slightly larger portion of its revenue into net profit. Although the differences are relatively small, Nestle consistently outperformed Dutch Lady across all three profit margins, demonstrating a slightly stronger operating performance. The final part of the profitability analysis is return ratios, which evaluate how efficiently a company generates returns from its shareholders' equity and total assets. Nestle recorded a return on equity of 91.28%, substantially higher than Dutch Lady's 19.21%. This indicates that Nestle generates much stronger returns for its shareholders, although its high financial leverage also contributes to these results. In terms of return on assets, Nestle again performed better, recording 14.06% compared to 9.56% for Dutch Lady. This shows that Nestle uses its assets more efficiently to generate profits. Overall, Nestle delivers stronger returns and profitability, while Dutch Lady maintains a more conservative financial structure with lower financial risk. That concludes my analysis. I will now hand over to my colleague, who will present the next analysis.
I am NURUL and FATEHA, and now I will present the market ratio analysis for Nestle and Dutch Lady to evaluate their market performance and investor perception. Market ratios are important because they help investors assess a company market value and future growth potential. The two market ratios analyzed are earning per share and the price to earning ratio. Based on our analysis, Nestle recorded a higher EPS of RM2.19 compared to RM1.61 for Dutch Lady. This indicates that Nestle generated higher earnings for each ordinary share, reflecting a stronger profitability and a greater potential to distribute dividends to its shareholders. Moving on to the price to earning ratio, Nestle recorded 41.9 times, whereas Dash Lady recorded 20.45 times. A higher PE ratio indicates that investors are willing to pay a higher price for each ringgit of earning because they have greater confidence in the company's future growth prospect. Overall, the market ratio analysis shows that Nestle outperformed Dash Lady by generating stronger earning per share and receiving greater investor confidence, making it more attractive from an investment perspective. To further explain this financial result, external research was conducted to identify the key factors influencing the performance of both companies. Firstly, brand strength and consumer demand played a significant role. Nestle maintained strong financial performance through its diversified and trusted brand portfolio, continuous production innovation, and resilient consumer demand. These factors contributed to its stronger profitability as well as its higher EPS and PE ratio. In comparison, Dash Lady focused on cost efficiency initiative and operational improvement. Although this effort improved its performance, its profitability and market ratios remain below those of Nestle. Secondly, operational efficiency and cost management also contributed to the differences in financial performance. Nestle enhanced productivity through rapid digitalization, disciplined cost management, and operational efficiencies across its value chain, resulting in stronger profitability. Meanwhile, Dash Lady continued implementing cost efficiency initiative and operational improvement, which helped maintain stable performance despite facing industry challenges. Furthermore, financial stability and growth strategy strengthened both company long-term performance. Both companies maintained stable financial position through prudent financial management. However, Nestle's stronger earnings enabled the company to meet its financial obligation more comfortably, while Dash Lady continued investing in manufacturing capabilities and operational improvement to strengthen its long-term competitiveness. Finally, investor confidence and market valuation further explain the market ratio result. Nestle higher EPS and PE ratio reflected stronger investor confidence and positive expectation for future growth. In addition, the company increased its total dividend to RM2.20 per share in 2025, demonstrating its commitment to rewarding shareholders while continuing to invest in future expansion. In contrast, although Dash Lady showed improvements in its financial performance, its lower EPS and PE ratio indicates that investors remain more cautious about its future growth potential.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh to the board of director, and my name is NASHRUL. So for today I will be presenting to you a comparative financial analysis of two consumer product companies on the Bursa Malaysia. So the first one is Nestle Malaysia Berhad and another one is Dash Lady Milk Industry Berhad, with the objective of recommending which company present the stronger investment opportunity for us. Alright, so let's look at the SWOT analysis. So here I present to you the slide. Alright, so I present to you here the slide of SWOT comparison, which is the strength, weakness, opportunity and threat of both companies here. Alright, so on the strength side, Nestle stand out with a superior efficiency. Its turnover inventory faster and generate more sales per ringgit on the asset. Its profitability is also markedly stronger, with a return of equity above 90% and investor confidence is high, reflect in its price to earning ratio of nearly 42 times. Alright, so that's about the Nestle. So on another side is about Dash Lady. On the other hand, hold the edge is in the financial stability. Its liquidity position is healthier and its capital structure is far more conservative. It carries significantly less debt relative to equity, less than the Nestle. It has also recently invested in a new smart factory which offer a long-term efficiency potential. Alright, so the weakness mirror this trade-off. Nestle liquidity is very tight, and it's rely heavily on the debt financing. Dash Lady, meanwhile, is comparatively less efficient and less profitable, and face execution risk in ramping up in the new facility. So now let's look at the outcome summary chart here. I put here. Alright, so across the 5 ratio category, profitability, the liquidity, efficiency, leverage and market performance, Nestle lead clearly in 3 out of 5. The profitability, efficiency and market, while the Dutch lady lead in liquidity and the performance. In the simple terms, Dutch lady is more conservative and lower risk balance sheet. Nestle is stronger operating and earning performance. The key question here is whether Nestle financial risk from its liquidity and leverage position is serious enough to offset the clear operating and earning advantage. And based on the numbers, it isn't. Nestle interest coverage ratio stand at over 13 times, meaning it comfortably cover its interest obligation from operating profit alone. That tell us its debt position, while aggressive, is being managed responsibly. Alright, so to sum it up, we come to our recommendation to the board of directors to invest in Nestle Malaysia Berhad, because we have these 3 reasons support this statement. The first one is earning quality. Nestle convert asset into the cash into the sales more effectively and generate significant higher return for the shareholder. Another one is market confidence. Its premium valuation and rising dividend up to 29% year on year reflect sustainability, sustain investor trust in growth trajectory. The third one is manageable risk. Despite higher leverage, its ability to service debt is not questionable. So Dutch lady remains fundamental sound, lower risk company, and could be revisited once in the new smart factory is fully operational and its efficiency ratio improve. But for now, Nestle offer the stronger risk adjusted return. So that's all from me. Thank you.